Sovereign Gold Bond 23-24 Series 3 is open for subscription from December 18th to 22nd. Today we have with us Vishal Dhawan, board member, Association of Registered Investment Advisor with us. Thank you so much for joining us today, Vishal.
It's a pleasure. Thank you for having me over.
Yeah. So, Vishal, my first question is, why is it that all experts seems to recommend sovereign gold bond?
So there are a few big advantages that clearly sovereign gold bonds come with. Number one is the fact that unlike other instruments where gold traditionally has never paid any sort of interest and it just gets put away in a locker somewhere and you hope for capital appreciation over a period of time, the sovereign gold bond is the only instrument available today which actually allows you to earn an interest every year of about 2.5%. Therefore, giving you some yield in addition to the capital appreciation, which may happen over a period of time. The second thing, which is the big advantage that it has, is that if you hold the bond for 8 years, then the capital gains that you make on it are actually entirely tax-free, which is again unlike physical gold or other instruments that you can use to buy gold, where you will end up having to pay some tax when you make a sale. And last but not the least is clearly the fact that it takes away the hassle of buying physical gold, uh, you know, storing it, ensuring that it's secure, etc. Because you can just buy it in a paper format, and that bond actually sits in your demat account, which is very, very useful.
So clearly, this is a good instrument. But what's the best strategy when it comes to buying sovereign gold bonds?
So I think the way to think about it is, there are clearly, with those advantages, there will be disadvantages that you also need to keep in mind while you build your strategy. So number one is the fact that, if you need liquidity on gold, and a lot of people buy gold because it's a very liquid sort of asset. Because if you run into a problem, you just go somewhere and convert it to real money. The sovereign gold bond, once it's bought, is not a very liquid instrument because you have to find a secondary market to actually sell it. And you normally find that that market is either a place where you will not find someone to buy it, or maybe you'll find someone, but they will not be willing to pay the price that you want to get on it because they understand that you are in a situation where you need the money importantly. So I think you need to keep in mind that the liquidity on the instrument is limited. And therefore, the way to think about it is when I'm buying, I need to be clear about what is my holding time horizon. If I'm buying for a short period of time, then I want to be careful because this instrument may not be the right instrument. The second is because I have to hold for 8 years, I have to be able to predict in some way what will be the price of gold 8 years from now, which is impossible to predict for anyone, whether you go to an expert or not. The fact that it's an asset which can go up and down depending on so many factors will have to be kept in mind. So what we therefore suggest to investors is that when you're buying, try to buy in tranches. Let's say you decide that you want to put away an X amount into a sovereign gold bond. Don't just buy it in the next issue that is available because you're saying, I want to just be done with it at one time. What you want to do is you want to buy gradually over multiple issues. You'll typically find that there will be 3, 4 issues a year that will keep coming through. And therefore, it's sort of a little bit of an SIP that you're doing. It gives you two advantages. One is it allows you to buy at different points depending on what gold prices are at that stage. And secondly, which is probably even more important, is that all of this money will not mature together at the same time. And therefore, you get something similar to what happens with maybe bonds, where you create a ladder where there are different maturities at different points because you can't predict the actual outcome that exists. And lastly, to remember that in your strategy also, um, because the liquidity on the secondary market is not very high, the primary market, whenever it opens up, like you mentioned, the next issue is opening on 18th, becomes a point at which you want to think about making some of those allocations because it's not available on tap, which means it's always available, unlike a mutual fund or a stock, where you can buy it at any time.
So can people actually lose money because of sovereign gold bonds, and how?
So actually, they certainly can. As much as there's this belief that you can never lose money on gold, you certainly can, because it is an asset which goes up and down in value, gold. Now, for this to be well understood, you have to go back to understanding what are the triggers for gold prices. So, if you're a gold investor in India, there are two drivers of gold prices. One is the price of gold itself in the international market. And obviously, there are times where it does very well. For example, just a few weeks ago, when the Israel-Hamas geopolitical issue broke out, you found all of a sudden that gold prices spiked very sharply, um, and they went up. Similarly, there'll be other points at which, when interest rates have been going up, you will find that gold prices in dollar terms go down. So, one of the determinants on how gold does is clearly just the performance of the price of gold, which can be up or down. The second determinant is going to come from how the rupee performs against the dollar. Because at the end of the day, there is a rupee value of gold that you are seeing when you buy into a sovereign gold bond. And traditionally, the rupee has always depreciated against the dollar over long periods of time. And therefore, you have got an extra return in gold, which has come because of the rupee depreciation. Now, if there is a scenario where the reversal happens for a long period of time, where the rupee actually appreciates against the dollar, then this will actually work against a gold investor. And this will work against a gold investor irrespective of the type of instrument he or she is using. Whether you're using a sovereign gold bond, whether you're using an ETF, whether you're buying physical gold, all of them will get impacted if the rupee appreciates against the dollar. So while the probability of this happening over 8 years is not very high, I think one should not say that it can never happen. That gold prices cannot come down over an 8-year period. There have been instances in the past where even over 10-year periods, gold prices have literally been close to zero. In which case, there has been opportunity cost that investors have had to bear, saying that I could have kept the money in a fixed deposit or some other instrument where I could have been better off.
Vishal, my second last question to you is, what should be the overall gold in your portfolio? And in this gold portion, how much should be physical gold, gold mutual funds, gold ETFs, sovereign gold bond? If you can give our viewers a quick breakup.
So first of all, the role of gold in a portfolio needs to be well understood. So normally you will find that gold works well as a asset class that behaves differently from how equities behave. So it's a very it's sort of your counterweight in a portfolio that you would look at. And therefore, we would say that for most investors, they should be looking at between 5 and 10% allocation to gold to essentially control the downside on their portfolio when other things go wrong. While they're doing this, they need to account for other gold that they may have in the form of investments as well. Because very often, the way investors look at gold as an asset class is they tend to count each instrument investing in gold as a separate investment itself, which is not the right way to do it. So the way to think about it is, I could have gold in multiple forms. I could be holding maybe some bars, biscuits, coins, etc., which also I can convert to cash if required, or which also goes up and down as gold prices move up and down. That's number one. Number two is I could have gold in a paper format already in the form of an ETF or in the form of a gold mutual fund. And the third thing I could do is now look at sovereign gold as well. Whether I want to account for jewelry that I use for consumption is very personal. I think most families that we have seen looking at their gold literally don't know the value of the gold itself. And the way that they think about it is, don't count it in my gold holdings at all, because I would never ever sell it unless it was a real crisis that our family is going through. And therefore, if you look at just these three buckets, gold ETF, mutual funds, one bucket, physical gold, one bucket, sovereign gold bond, one bucket, this combination should be that 5 to 10% at your overall portfolio level. Now, once you've made that decision, it now becomes a function of how important is the liquidity on my gold and how much am I going to try to time my entry into gold when I'm making the decision. If I'm very comfortable with holding for 8 years, saying that really I'm not going to pull this money out in any situation, then clearly the sovereign gold bond is the best option because it's giving me that 2.5% and it's giving me a tax-free return on top of it. And I would then say that maybe you could look at all your gold allocation being only in this kind of an instrument, as long as you buy it in a staggered manner. If, however, you feel that, I do want some part of it to be liquid, then clearly, having um, half of it in the combination of physical gold and gold ETFs or gold mutual funds is a good option. And again, even when you're doing that, it's important to stagger your purchases because it's very hard to predict how gold prices will move in the short term.
Clearly, investors should climb this golden ladder. But my last question to you is there any kind of investor who should absolutely not enter, this kind of instrument or buy sovereign gold bond?
So I think there are two types of investors who have to be very careful. One is those who need liquidity. Like we discussed earlier, liquidity on this instrument is very low. And therefore, if they're going to if they're likely to require it, maybe they take loans against their gold. Otherwise, maybe they actually sell physical gold or they sell their gold ETF if required. Then the sovereign gold bond doesn't really fit in. I mean, on paper, there is liquidity, but in the real world, there isn't enough. So that's one set of people who should not buy it. The second is that the tax-free nature on maturity is very valuable for those people who are in a higher tax bracket. If you're in a very low tax bracket anyway, that may not be as large a benefit, and therefore the benefit that you're really getting then in the sovereign gold bond is the 2.5% of interest that you get per year, and you're trading that off against the liquidity on the other side. So I think lower tax investors may want to give it a careful thought on whether they really want it. And clearly, anyone who requires liquidity, I think they should think many times before they go in for a sovereign gold bond.
Thank you so much for your inputs and your time today, Vishal. You have a lovely day ahead.
Thank you so much. It's been a pleasure.